Financial Risk 2024 are its current and required capabilities. As you are aware, we have been arranging for a series of webinars regularly with an intent to develop skills and build capacity in our member banks in the ESG matters. In line with that, today we have Climate Bonds Initiative and Octus ESG with us for this knowledge sharing session. The participants are officials from member banks actually who are in the sustainability, risk department, strategy, business, compliance and credit. As we are all aware, on February 28, 2024, RBI issued draft guidelines on disclosure framework on climate-related financial risk 2024. The framework mandates disclosure by regulated entities on 4 key areas of governance, strategy, risk management, metrics and targets. Our session today will cover some insights on the key areas at an introductory level. And after gauging the requirements in today's session, we may later have a series of sessions for an in-depth discussions. Friends, without any further ado, we will welcome our speakers from the Climate Bonds Initiative and Octus ESG. I would like to introduce them with their brief profile. First, we have Ms. Neha Kumar, Head of South Asia Program, Climate Bond Initiative. Neha, through CBI, drives policy, strategy, and partner programs to scale up green bonds market and sustainable financial ecosystem. She serves on the committees of IFSCA and NITI Aayog on climate finance and has been on the Ministry of Finance Working Group on Sustainable Finance Taxonomy Development and international ESG standard setting bodies. Our efforts are targeted at building policy mechanisms and market infrastructure needed to accelerate finance for green, just and resilient transition, creating capacities across sovereign, sub-sovereign, financial and non-financial entities, DFIs and regulators on climate risk and green finance. She has 2 decades of experience in responsible financing, environmental and political risk, and is trained in science, international environmental negotiations, and politics. The other speaker we have today is Mr. Surjit Iyer from Octus ESG. Mr. Iyer is a finance and sustainability professional with 17 years experience. Previously, Mr. Surjit worked with Motilal Oswal Financial Services, UBS Investment Bank London, Evalserv, Grameen Capital, and UNEP Sustainable India Finance Facility. He has authored 3 books on regional economics and published some 170 articles on sustainability, business, and finance. I thank CBI and Octus ESG and request the participant to take maximum benefit of these knowledge sharing sessions. So now, without much ado, I will just hand over the forum to Ms. Neha. Neha, please.
Yeah. Thank you, Mr. Chandrasekhar, and good afternoon to everyone in this session. And as Mr. Chandrasekhar said, that this will be an introductory session, but we will try to cover some of the salient points which many of you have shared with us in terms of the requirements and challenges that you feel that must be addressed. I just would like to make 3 points before I hand it over to Mr. Surjit Iyer, who will take the first 30 minutes and cover a part of the presentation. One is, if we can move the slide to the next slide. We have, can you move to the next? Yeah. I just wanted to share this with all the colleagues over here from the banks that a year and a half ago, Climate Bonds Initiative led consortium, which comprises Octus ESG and ODI, which is an international think tank, with the support of various organizations, including the UK government, came together to launch this initiative called India Initiative on Climate Risks and Sustainable Finance. I am making a point of introducing this initiative to everyone because you will realize that in today's discussion also how different points and how different dots get connected. So part of the initiative is working closely through its empirical research and evidence of what central banks are doing and engaging very closely with the Reserve Bank of India. And that engagement and that part of research work has been going on for nearly 4 or 5 years. It covers both microprudential and macrofinancial aspects of transition and covers the approaches that different central banks are taking in addressing and in actually engaging with the regulated entities on managing these risks, harnessing the opportunities, and also implementing disclosure framework. The other two other 2 legs of this initiative are extremely relevant for what we have begun doing today, along with the IBA, for which we are very, very thankful. It is about knowledge dissemination and capacity enhancement of financial sector, which is the second pillar. And what we are looking at is that it is not only the compliance or the risk part of it. Of course, this will form a quite a massive chunk of the exercise, but also to really engage with the banking institutions, financial institutions, on how to really tap into the opportunities as well, which are brought forward by transition that we are undergoing, and where banks will play a central central role. The other part of it will also be about linking up banks with their corporate clients, with their borrowers, as well as investors, in order to really fully harness the opportunity that lies in front of us, as well as the challenges. The third leg of it actually deals with the corporate entities, which are in the high emitting sectors and hard to abate sectors. We are focusing right now on industrial sectors like cement, like steel, and also the high emitting power entities, who actually form a which are major actors in the real economy, and the real shift must happen over there. So how can they engage with their lenders and their investors is the part of our third bit. And then all of these learnings we will intermittently share, not only with Indian stakeholders but also with international stakeholders, to really get all of these things mainstreamed, and also really focus on the emerging market perspectives in the global fora. So this is one part that I just wanted to make a two-line introduction with. The other part is that most of you would know Octus ESG, our partner. In the previous leg of this initiative last year, we ran a program of what we call foundational trainings with as many as 12 to 14 banks. A couple of those trainings are still remaining to be done. And today's session, it will also bring together some of the learnings that we had, both the and it was also a learning for us in terms of understanding how banking institutions have really actually progressed from where they were 5 years ago and what they are engaging with today. And a huge part of that is actually, the credit goes to the regulator, the Reserve Bank of India. I think with the publication of its discussion paper, and now with the draft guidelines on disclosure, I think it was pretty much set the ecosystem in that sense to really take this challenge and opportunity head on. So a lot of you have also been engaged with the RBI. RBI has conducted bottom-up exercises in understanding the current level knowledge, know-how that exists. And what we've been hearing, of course, together with you, is that with this disclosure framework, the attempt is to really get everyone started. So today we will do exactly that. We will get everyone started. And how we have structured is this interaction is in two parts. Saurajit will take us through risk management aspects of it in a step-by-step manner. And then I will look at the transition planning, plan and finance part of it, which will also cover some high-level aspects on metrics and targets. Thank you so much again for sharing with us in the last couple of days what all you want to hear, not only today, but going forward. We may not be able to cover all of these topics in depth today, but today's interaction and after we present, your inputs will really help us design very targeted, in-depth sessions as we move forward. So I will give it to you, Saurajit, to take us forward.
Thank you. I hope my audio is going fine.
Yeah, we are able to hear you.
Thank you. So thank you, Neha. Thank you, Chandrasekhar sir, and entire IBA team, and welcome to all the participants. I mean, we have very limited time, so there's only that much we can really touch upon each subject. But in case you want to know more, like Neha just alluded, we have been conducting these, fully funded technical assistance capacity building programs with banks. So do get, get in touch with us in case you're interested in for that. So climate change, maybe moving to the next slide, please. Climate change is really an issue that has started to affect the credit and equity portfolios globally. And the risk and opportunity impact of it is really very, very similar to what you saw with digital banking a few years ago. So if all of you really ask yourselves that, the question that why did your banks actually look at digital banking methods back then a large part of that logic of risk and opportunity actually holds true even now for the reason why you need to look at climate action. So if I put it in a very simplistic way, climate action is the new digital revolution, if I put it, in that sense. So in this session, what we'll talk about is a few steps towards effective climate risk management and transition planning. Let's move to the next slide, please. So in terms of risk identification, sector and locational analysis is one of the first steps towards climate action. Now, climate risk is really made up of physical and transition risks, as many of you would know. Physical is due to the extreme weather events. Those are increasing each year and cause a lot of damage to fixed assets. They disrupt the business cycle and basically create uncertainties in cash flow and your repayment cycle. Transition risk, on the other hand, is really due to the change or the transition to a low carbon economic model and the impact it would have on what are the erstwhile business as usual sectors to which your banks have exposure to. Now, and that is really why it's relevant. So the impact of physical and transition risks on the bank really depends on which locations and sectors the portfolio has material exposure to. So these sort of extreme events occurs in specific geographies. Transition risks, related to policies, regulations, demand change, they might be happening in specific jurisdiction. So in some cases, it might affect certain sectors more than the others, depending on the nature of the portfolio. So the way it goes about is that if you overlay the map of the vulnerable geographies and the sectors, that gives some indication or clue of the climate vulnerability in your portfolio by identifying the risk hotspots. And that's really the core purpose of sector and locational analysis. So if you look at the maps on the left side of the screen, you will see certain geographic regions of the country most afflicted historically by physical risks. Obviously, this is historical data. Better analysis can be done using forecasted data. On the right side of the slide, you see certain geographic regions where certain economic sectors are concentrated because of how their production, the units and the ancillary industries are located. So in this takes the example of chemicals, pharmaceutical, and automobiles. Most banks have decent exposure to these sectors. Now, if you overlay the locational maps with the sectoral maps by using your portfolio data, you can make a rough assessment or estimate of where the sectoral and locational vulnerabilities may be most high in your portfolios. And this sort of gives you a visual depiction of that. One point I want to add here is when you are looking at sectoral locational analysis to identify risk hotspots, also look at the adaptive capacity of that region. So different regions, at a country level, different countries, or at a provincial level, different states may have different adaptive capacity to tackle the impact of climate shocks. And that really depends on the state of the region's economy, the public finances available. And this needs to be considered because that can actually have a positive effect to reduce that vulnerability. So your risk will get reduced to that extent technically. Next slide, please. Another, aspect of risk identification is about materiality. So material issues are really those issues like if we know in advance what would be the likelihood and impact of those issues, then that would actually influence the business decisions that we're taking now. That's really what a material issue is. Now, it really depends on the contextual factors, again, connecting to the sector, locational exposure we spoke about earlier. but it also looks at certain critical business drivers like customer growth, customer stickiness, or what are the operational processes involved, what is the capacity, what are the, are the firm's assets being used, are the assets being sweated enough, so on and so forth. Now, when we particularly talk about climate materiality mapping, we need to sort of keep in mind the future orientation of climate risk, because that is really where sustainability risk differs from climate risk. Sustainability risk is very largely historical in nature. Climate risk is more futuristic in nature. It's about future risks lie. But at the same time, I want to caution that when we use the word future, it is not about something far into the future, as is often believed by many people in the market. Climate issues are stochastic in nature, which basically implies that there can be a random probability of occurrence as soon as tomorrow. It need not be after 20 years, 30 years, 50 years, etc. And we're already seeing evidence of this. If you really look at the news and the science, what those things are saying. So 2023 was the hottest year on record, prior to which 2022 was the hottest year on record. And now almost each month of 2024 is turning out to be the hottest in record. So what does all of this really tell us? These are basically one way to look at the effects of climate change that is already occurring around us as we speak. And therefore, the random stochastic nature of an event means that it can occur at any time in the given future. Now, at the same time, do keep in mind that the carbon emitted into the atmosphere, which is really what emissions is all about. Emissions lies at the crux of climate change. So carbon emitted into the atmosphere actually stays in the atmosphere for a very, very, very long time. Now, I'm not going into the scientific details of it, but it's largely sufficient to say that this stretches the duration of probable risk. Next slide, please. So very quickly on the green asset ratio, it really talks about the proportion of loans in the portfolio aligned to what is defined as green activities. Now, green asset ratio really helps to identify certain potential transition risks of climate change. If it is more, then the risk from probable regulations, technology changes, market demand shifts may be more. The challenge here really lies in the fact that taxonomies are still evolving in many countries, but emissions growth is continuing leaps and bounds. And so in case official regulatory taxonomies are still in process, a lot of banks in many markets, what they're doing is they're developing their own definitions, their own approaches to estimate this. And a lot of media reports do suggest that a lot of those banks are enjoying improved brand value in the market, which then translates how multilaterals, institutional investors and millennial generation clients look at those banks vis-a-vis other competitors. Secondly, while most banks look at negative screening or exclusionary screening as one of the initial steps towards business sustainability action, that may not necessarily really solve the crux of the problem, which is financing the reduction of emissions itself, which then brings us back to the topics that we've been talking, green asset ratio and all the topics that we've spoken previously. And that's really why green asset ratio can really prove to be a very useful indicator by enabling the channeling of capital towards those economic activities that contribute towards decarbonization. So ultimately, what happens is negative screening may just shift emissions from one entity to another. So that's really where the difference lies. Next slide, please. So let's now look at risk measurement, starting with climate risk scoring. Some of the typical assessment approach for assessing physical risks. It really looks at elements like hazard, vulnerability, and exposure. Hazard is related to the physical risk, extreme weather events that may materialize in the particular geography that we are analyzing. Different geographies are subject to different extreme events. And the objective is really to see which hazards may have higher probability in that location and which economic sectors they would impact the most. Vulnerability assessment is really in terms of the severity and frequency of the risk. The objective is to assess the damage caused to the physical assets, the collateral, the disruptions caused to business continuity, resource availability, and productivity. The last step is about exposure. This connects to the underlying company, their assets, their resources that are being used in the business, the workforce that is engaged in that business, and how much of that actually falls directly in what we call the line of fire of a physical extreme weather event. Now, probabilistic based scoring may be used to arrive at a physical risk score. And the idea is to match this with what the climate sciences is really talking about in context of that particular region. Next slide, please. So that was about, physical risk assessment. If we look at the typical assessment approach for transition risk, it really starts with carbon footprint of the financial institution, especially financed emission, which we will talk about a bit later in this section. So emissions can really be shown in absolute or intensity terms. So absolute emissions or emissions intensity. So emissions intensity is a ratio that looks at the emissions relative to the revenue or market value of investment or physical output, while absolute emissions, as the name suggests, it looks at it as a whole. Now, a lot of banks in the initial steps analyze the change in the emissions intensity ratios, the targets they put towards transition management as part of transition plans is also in terms of emissions intensity ratios. But it's important to keep in mind that it is actually absolute emissions that is the most critical as far as the climate problem is concerned, because reduction in emissions is fundamental to solving the climate crisis, and emission intensity ratios may not always do that. Why do I say that? I say that is because, especially in context of rapidly growing emerging economies, the GDP is growing. Obviously, the credit needed to create that GDP growth is also growing. And as the access to credit, the demand for credit rather increases, that means the loan books of the banks is also growing. So even if we use a relative ratio, if the denominator is increasing, then it also means that the numerator is actually increasing. So if you look at the arithmetic part of it. So while the relative in such cases, it's actually counterproductive, right? So while using a relative ratio, the advantage is that it, sort of helps tackle internal resistances a bit. But in reality, it has limited value, in terms of the broader economy or the broader, the regional context, if you look at it that way. So things have to be taken in context, while discussing or while deciding on these issues. The next slide, let's go back to the previous slide. So the next point that we wanted to also touch upon in transition risk assessment is about what triggers transition risk. So this is really where some of the inputs from the sectoral or the locational analysis would be useful, really to assess how changes in policies, regulations, alternate technologies, or how certain segments of consumers are changing their demand patterns. How does that impact the entire sort of the financial or the business position of the counterparty, and therefore the financial position of the bank? The third element here is to look at the impact of a possible carbon price on the underlying counterparty, and how it would impact its operating cost, profit, discounted cash flow, and ultimately the ICR, or the interest coverage ratio. Now, there are different ways to assume an implied carbon price. You can look at global prices that are being used. There is a academic concept called social cost of carbon that has come out. One of the most commonly used methods is really to look at the ratio of emissions vis-a-vis units of energy consumed, and then use that factor, that ratio, into the operating cost of energy. So your operating cost of energy increases by that factor, and so the OPEX increases by that extent. I hope this, it's basically simple arithmetic, right? So ultimately, as the OPEX increases, it creates an adjustment to the discounted cash flows of that borrower, which then impacts the interest coverage ratio. And the idea is to see whether the ICR remains within the minimum acceptable ICR range or not of that particular bank. Now, in this context, obviously, carbon price, there is an element of pass-through, because depending on the price elasticity of a particular product, you can pass it onward to the consumer. So the impact on the producer will get reduced to that extent. So obviously, these elements also need to be taken into consideration, depending on what you are analyzing. Now, all of these three elements, carbon footprinting, transition drivers, and impact of carbon price, can be used to create a probabilistic based scoring for transition risk. Next slide, please. So we touched upon emissions a bit in the previous slide. So now let's go a bit into a bit more detail. Its emissions estimation is a key part of baseline calculation to measure climate risk. Now, as per the GHG accounting protocol, they really divide this in three parts: scope 1, scope 2, and 3. Scope 1 is really the emissions generated by sources that are controlled and owned by the bank in this case. Could be, your vehicle fleet, generators you are using in branches, so on and so forth. The scope 2 is really where you can control the consumption, but you don't have any control over the generation. And this is where it differs from scope 1, because in scope 1, you had control over the generation as well. So scope 2, the simplest example is the electricity that you're purchasing from outside. Scope 3 is really more indirect in nature. It's about 15 categories, upstream categories, which is all about the purchased goods, services, and then you have the downstream categories, which is all the use of the bank's products and services. What concerns banks the most, and I'll come to later why this is the most concerning, is what is called as the category 15, which relates to financed emissions. But before that, let's, if we look at it from the low carbon transition journey or strategy of a bank, it's really twofold in this context. One is decarbonizing the own operating emissions, and own emissions is related to scope 1, 2, and a lot of the scope 3 in the sense with exception of category 15, basically all emissions minus portfolio emissions, if to put it very simply. The second aspect is about the portfolio emissions, or also called the financed emissions. So for financed emission, obviously a bank considers its borrower's emissions, which in turn would be the borrower's scope 1, 2, 3 emissions. Now the issue here lies, like you see in the graph on the right side of the screen, a lot of industry analysis is showing that financed emission on an average amongst FIs is as much as 700 times higher than direct emissions, because generally that is what you'll find in most services sector economy organizations. So which means what? Which means that portfolio emissions is a far larger problem than solving a bank's own operational emissions. And so the climate action by a bank really needs to look at reducing portfolio emissions. Reducing operational emissions is a good start, but it's not the sufficient. What makes it sufficient is also the reduction in portfolio emissions. And this basically highlights the significant impact that banks can have through their financing and lending choices by financing those activities that can enable the reduction of emissions in the country. Next slide, please. So this is the PCAF formula for calculating financed emissions. Just a bit, just to detail it out a bit. It has two components: attribution factor and the emissions of the borrower. Attribution factor is the share of the outstanding loans extended to that company or project by your bank. So it is basically the proportionate of the capital that you have extended to that company, which is being used to do the business activity that it is doing, which in turn is causing the emissions that it is emitting, right? So this attribution factor is the share of the outstanding loans you have extended divided by the total capital of that enterprise. So when we say total capital, if it is a listed company where equity and debt is listed, it will be the total enterprise value or book value if it is, the capital is at book value, or it can be the project related equity or debt in case of project financing SPVs. The emissions component is really based on the amount of energy that is being used multiplied by the calorific value of the nature of the fuel and the emissions factor. Now, PCAF suggests that absolute emissions and emissions intensity, either of them can be used. Like we said, absolute emission is the total amount of emission. There are various kinds of GHGs, so emissions are denominated as what is called CO2e, carbon dioxide equivalent. Emissions intensity are in 2 or 3 parts. One is where you look at physical intensity in terms of units of activity. The other is economic intensity, which you look at, in terms of revenue or the, sort of monetary indicators. Multiplying the emissions component and the attribution factor would give you the financed emissions for the bank pertaining to that particular borrower. And the sum total of the financed emissions across all the counterparties will give you the financed emissions at the level of the bank's portfolio. Now, this calculation is typically at a given point of time, and the outstanding amounts are based on the drawn amounts of funds provided to counterparties based, as per the year-end balance sheet. Next slide, please. So we looked at climate risk scoring, we looked at financed emissions. Now, climate scenario analysis is also an integral part of risk measurement. It's really an assessment of plausible future pathways that the economy may move on at certain levels of global warming. And it looks really at both the positive and the negative financial impacts of climate risks and opportunities. Now, the process really starts with identifying the boundaries of what needs to be analyzed. Like, are we looking at the entire business? Are we looking at certain portions of the portfolio? Are we looking at specific sectors? Are we looking at specific hazards? There have been cases of banks in emerging markets in South Africa and others where, a lot of those banks are transnational in nature. They're operating across different markets in that continent. And even at the first instant, they started with the entire boundary, if I put it that way. So all the subsidiaries across all the geographies at one go, because otherwise their logic was that the number really does not give a true complete picture. But obviously these approaches will vary from bank to bank. The main thing is start of the process. That's most important if you really look at it that way. So this process is really done also in conjunction with the stakeholders that have interest in the enterprise. One of the key objectives of this engagement with stakeholders is also to get a buy-in from the top, because at the end of the day, climate risk management is ultimately risk management. Climate transition, it's a business strategy. So anything to do with strategy, it's very important to get the buy-in from the top, because otherwise it's difficult to sort of put any strategy across the entire, execute it across the organizational hierarchy. Another key aspect of this is obviously to identify the material climate issues of that particular portfolio. There are some reference scenarios that have been provided by credible institutions. A lot of banks are using the NGFS scenarios. IES scenarios are being used a lot for transition risks. There are certain sector-specific IES scenarios as well. Now, these reference scenario really helps to understand what would be the impact on macroeconomic drivers if the world would. So what would be the impact on indicators like GDP, population, interest rate, inflation, the state of the capital markets, and so on. And these interpretations have really been done by a lot of complex climate science integrated assessment models. So, generally, one would say that it's best to start off with these reference scenarios rather than complicating things by trying to devise own scenarios. The what if analysis approach is really useful here. It helps assess what would be the probable impact of those changes in macroeconomic drivers on two things. One is the business value drivers of the underlying enterprises, and therefore, because of that, the financial risk indicators of the bank. So that's how the process flows. The impact of climate on the economy, therefore on the business, and therefore on the bank. So the what if analysis approach is really trying to sort of put out or chalk out at least some qualitative assessments at the beginning of what could be the plausible outcomes. Now, once this process is done, one of the key steps is also to communicate it across the organization, because the achievement of a climate transition, climate risk strategy, like I said, it's essentially a strategy, it's a change management exercise, and any change management exercise runs across departments, it runs across functions. So it's very important to communicate the expectations across all the organizational departments properly so that everyone knows what is the ask for them. The progress needs to be tracked periodically, and there may be situations where the what if analysis or the targets needs to be amended, because climate is a very evolving topic, and so an iterative approach is essential. Next slide, please. So one of the last sections for my portion, just want to sort of connect climate risk to the impact on credit risk. Just to summarize, and some of these things have already been spoken about in the earlier slides to some extent. at the end of the day, the impact is really to look at what would be the impact on the expected cash flows of the borrower. That's what really it boils down to, right? So the borrower in question may be a firm or an individual. Let's look at the case of the firms. So physical risk may impact their fixed assets. It may impact their production capacity. It may disrupt their supply chain, distribution networks. It can lead to worker productivity issues. It can disrupt the continuity of demand from customers, so on and so forth. It may also impact the collateral values of assets that are held by the bank. Similarly, on the transition risk side, the cash flows may be impacted because new policies, new regulations that come up, they may put incumbent assets that have been financed by the bank at risk of becoming stranded assets. And that impacts production continuity. There may also be changes to demand for emissions intensive products and so on. Now, all of this impacts the revenues of that borrower in terms of an impact on either price or the quantity. There may also be impact on the cost side, both OPEX and CAPEX. Physical risk may impact OPEX due to the cost of repairing assets. There's a cost in case of, temporary distribution networks need to be put up. In case of additional insurance premiums may need to are required to safeguard from extreme events. It can lead to CAPEX if new capacity addition is required to improve resilience of the firm, right? Similarly, on the transition risk side, a lot of new production processes or marketing costs that may be required to showcase the low carbon credentials may impact the cost structure of that company. A lot of investments in R&D of new low carbon technologies may increase CAPEX specifically. Even the cost of capital may be impacted due to the change in perceived risks of that organization, and therefore the discounting rate that is used to discount the future cash flows. Ultimately, all of this impacts the debt serviceability estimations of that borrower, implying a possible credit risk for the bank. Next slide, please. So one way of looking at the impact is to look at the expected loss and connect to this. Like the standard formula of probability of default, loss given default, and exposure at default. The probability of default, based on historical credit default data at a particular level of internal rating, may be adjusted due to the absence of climate-specific credit default data by using credit default data that is pertaining to ENS issues, if that is available, to sort of create a proxy climate probability on default method. An additional component that may be included in this formula from a climate perspective is really the uncertainty factor, especially for acute physical risks. That's because, like we said earlier, climate risk is really random stochastic in nature. It may occur at any time, not necessarily after a particular time period elapses. But that said, obviously, these approaches are evolving because the inherent nature of climate risk it's still an evolving topic. And so the approaches used by different banks globally and especially in emerging markets vary quite a bit. Thank you. I will now hand it over to Neha for the next part of this presentation. Thank you. Over to you, Neha.
Thank you, Sarojit. We can move to the next slide. I will dive into where you left, and you definitely talked about the macroeconomic impact, macro financial impact. I just wanted to emphasize this by saying that we have net zero targets set at 2070. Globally, Paris and IPCC have set it at 2050. But both of those timestamps would actually be too late if we do not really take action now. And so what really matters is this decade. What really matters is the next few years, in which we will need to know how we are managing the risks and how we are financing the projects and activities which will take us away from high carbon and more riskier kind of projects. What does this mean? It does mean that we are really looking at a steep decarbonization curve. And the investments as well as management of risks will require to be really, really upfront and front-loaded. And in case of India, it only does not mean that it is only, decoupling growth with emissions, or it is only decarbonization. It is a steady low carbon development pathway, which will have to take into account that it does mean that it is net positive for people, that it creates jobs, it doesn't disrupt jobs to such a degree that the new ones can't really take its place, and there is not proper substitution. It will also have to go a little bit beyond climate. So that is the other thing that would soon be upon us, which is in the realm of nature. It is going beyond climate, it is going into biodiversity, it is going into other issues, other natural capitals like water. And this will be extremely important for the banking sector as well. Moving on to the next slide, I really wanted to touch upon some key highlights that our forthcoming research is pointing towards. If you look at the exposure, then it will really tell us that the imperative is really upon us. On the left-hand side, you would see that there are some key highlights for the Indian banks. On the other side, on the right-hand side, there are certain numbers that we have been able to cull out from our research in terms of the corporate borrowings in high carbon sectors. Now, what we find is that there are significant disparities in terms of sectoral exposures among different banks. In certain cases, there may be a small bank with a very huge exposure, but the share of that bank, in terms of the market share, etc., and its lending share may be very limited. The other thing is that some banks have very high exposure to specific sectors than others. And something has to be said about also the systemically important banks, what we call DSIBs. There are three of them, as we all know, and they account for 40% of the total bank lending. And a large part of this bank lending is towards fossil fuel sectors like power, transport, refinery, and cement. And like I just mentioned, some banks, they have high exposure despite holding small percentage of total bank lending. And this concentration actually poses a significant transition risk. There is then the other factor that the financial system is interconnected, and that interconnectedness itself in the system poses systemic risk. Now, if you look at the large corporate borrowers, then electrical utilities form the largest chunk. They are the largest borrower. They account for nearly 16% of total borrowings. Oil and gas also amounts to nearly 9%, 8.5% of total borrowings. Renewables, as you would see, that even though there has been a rise in renewable energy lending and also investment, financing for renewables through banking sector is really 10.3% and not, it hasn't gone beyond. And it also has to, we have to really look at it also in terms of the targets that we have set for ourselves in India. So the combined borrowings by fossil fuel-based industries, which would include refinery, aluminum, etc., and high-emitting industries, that nearly comes up to around 23.5%. Now, the top borrowers, they account for about 40% of the reported borrowings, and 15 of these 25 top borrowers are actually fossil fuel-based companies, and they make nearly 16.5% of both domestic and international borrowings. And if you look at the top 10 energy intensive sectors, they account for nearly 30% of domestic borrowings, and which this was a calculation done in 2023. Now, all of this indicates that we are facing an imminent task upon us, that we have to be looking very methodically and very carefully on certain sectors and on lending and borrowing patterns. So what will this mean for individual banks? That their portfolios will need to be realigned. They will need to measure the risk that is sitting on their portfolios. And the other part of it is that it will not be enough to only know and disclose what you're doing, because half of the problem would be, or half of the part of the work would be, how your borrowers are doing, how the corporate clients are doing. So the engagement between lenders and borrowers will have to become a central part of the strategy. And the other aspect is that all of this, while there is, the risk aspect of it, but it also, there is an imminent financial transition opportunity that we have upon us. Now, financial transition opportunity for banks actually builds upon the progress that we have been making in different sectors, and also in terms of the national trajectory. Now we have set the 2070 net zero target, but our sectoral transition pathways are not yet clear in terms of the final, thresholds that we'll have to comply with. And also at the same time, the rate at which and the extent and the dynamics of how the transition takes place, it is going to shape the opportunities, it will have business implications, and it will also pose potential strategic risks to financial institutions as they get into this realm. They have to develop new solutions, and they will also have to retain their own individual competitive advantage. So we are not in a system where we will be able to set climate targets and climate risk management targets and financing targets in isolation or in insulation of the wider system that within which we are working. But what we are saying, you can really at this moment almost assume that the base case scenario will bring in certain disruptions, and that will have significant implications on the financial needs of the real economy and therefore financial institution strategy and engagement. So when all of this is happening, I just thought that it would be good to see what is happening around us. What are the, global frameworks, global developments, which are really evolving very fast, and they are also, they would have implications for us as well, because standardization in the in how to manage, how to understand, how to set targets will mean that there is certain basic universal understanding of how we are looking at things. Now, if you move to the next slide, just wanted to make one critical point over here, that if it is not only about targets, and it is not only about, isolated risk management, transition planning, like Saurajit also alluded to, has different components to it. And it really is a way of aligning your opportunities and risks and associating that with the real economy's low carbon transition. So it is a part of your business plan and a business strategy. And the focus definitely is on strategic planning and concrete actions. So transition planning is very much an internal exercise that a financial institution undertakes. And the outcomes of it are actually, they result in what is now becoming increasingly popular tool. The outcome of it is the transition plan, which is an external document, and it is a communication tool. It is a strategic tool to engage with your clients, your customers, your investors. Now, moving forward to the next slide, please. I just thought, what are we seeing? And when we talk about transition planning and transition plans, what is the kind of expectation or what are the different frameworks outlining for us in terms of the components of both of these aspects? So there are many market-based voluntary frameworks. You would have heard of Carbon Disclosure Project. Many of you are also probably reporting to them. In fact, CDP has there is an India report in which it is assessing the transition plans or decoding the transition plans of Indian financial institutions. And the heading itself is instructive. They are decoding, which means that transition plan is a separate item probably may not exist within the financial institutions, but the elements of it in terms of risk management, in terms of governance, in terms of setting metrics and targets, they do have, they have started evolving. Then we have SBTI, and then we have, which I think also a lot of you are familiar with. This is a science-based target initiative, which is basically looking at trying to, clarify what kind of targets which can be set. And this is basically in alignment with the Paris targets. The other is GFANS, which is the Glasgow Financial Alliance on Net Zero. It also has different kinds of alliances within itself. For example, Net Zero Banking Alliance. And you would see that most of them, they are aligned to science-based scenario analysis. They are looking at that kind of input into the strategic positioning of banks. They are looking at not only mitigation, but in fact, some aspect of adaptation, at least at the governance level, but not so much at the implementation level. And when we talk about physical risks, this is a very, very important aspect, I think, for Indian banks. A lot of the exposure of assets lies in climate vulnerable regions. There is a huge swath of India which actually faces these hazards, and it is climate vulnerable. And how does that physical risk aspect translate itself into either extra provisioning? Also, at the same time, adaptation financing is an important aspect for banks, when you look at it. Then all scopes, which is scope 1, scope 2, scope 3, that Saurajit was mentioning, they are covered in data and metrics in all of the three frameworks that that I have on the screen over here. And then the net zero targets are also in all the three, but net zero target backed by interim targets, they do not find equal, emphasis in all of these frameworks, in the three frameworks that I have just mentioned. The green circles, they will tell you there's a full coverage of those aspects, and the aspects are on the left-hand side, which is scientific basis for strategic positioning, considerations of climate versus other financial performance drivers that I was mentioning, that it is not only climate performance, you also have to look at your profit. You also have to look at your bottom line. So how do the two things come together? Then data and metrics and target, scope and coverage, implementation activities, and organizational and integration governance and disclosure. These are the 7 things that these frameworks have commonality on. Partial coverage also means that this is an optional requirement. And I have taken this and the next slide from an analysis done by Deloitte. I will move to the next slide because that is also equally important. This is talking to you about jurisdictional requirements. Now, RBI has also come out with the requirement, but there are different jurisdictions which are either pushing forth voluntary, disclosures, or they are looking at, in some cases, mandatory aspects as well. Most prominent ones are, Singapore. Then we have a transition pathway taken up by the UK, and looking at much more the European jurisdiction. And then we have EU itself. And then there is very important one that some of you would I think most of you would know, which also Saurajit was talking about in the case of reference scenarios, which is the NGFS, which is the Network of Greening of Financial Systems. And it has in fact come out with a whole package on transition plans. It is saying that you need to connect financial institution transition plans with the non-financial firms, because both will talk to each other. The credibility of each depends upon the other. The other one is that you need to have certain different kind of not different kind, certain different set of indicators or parameters when it comes to emerging market transition plans. And what we have found is that decarbonization is very much in focus in the developed world, but in the emerging economy, adaptation focus also emerges as part of transition plans and issues that the banks and the financial sector is dealing with. And then something called the third thing, which is on the microprudential perspective. NGFS basically talks and makes all of this collection to inform the supervisors, to inform the regulators. So it really has taken that perspective. And in that perspective, risk management, governance, disclosure are also very dominant part of the NGFS transition plan research and some kind of directives for both the regulators as well as things that the banking sector should be looking at. Now, moving on. So what is that? I think the key message that I wanted to lay on the table was that there is good news, and there is also, of course, some very, palpable challenges that we have in front of us. The good news is that transition planning or transition plan is not an additional activity. A lot of the things that the banking institutions, the banks and the financial institutions will need to do when they are addressing climate risk or climate opportunities, they will be looking at it in terms of the risk management, as Saurajit has talked about. They will be putting some of those metrics already in place. They will have to have some kind of governance and oversight on this. There is no way that you can go, and not do scenario analysis. So while you will have to be doing all of these things, all of these will get streamed into your internal transition planning, and in a systematic way when you disclose it to the external stakeholder into a transition plan. Now, transition plan also becomes a very effective communication tool, and it also becomes, it basically organizes all of the activities in a systematic pathway, because it takes a long-term perspective, but also breaks it down into the near term and the milestones which will be required to achieve, your transition plan towards net zero. Or we will also come to it that is net zero the only climate target? Is there also difference between net zero and carbon neutral, etc., which can also be targets that the financial institutions they have been adopting as well. Then transition plan will give you a very visible picture on how to optimize for climate induced disruption. And definitely, like both Saurajit and I, we are just reiterating the point that it is a key engagement tool with investors, clients, and counterparties. Now, I just wanted to, if you look at the picture over here, there is a transition plan which is focused on decarbonization, on emissions reduction. But as we also said, the other part of the transition is also adaptation. Without really focusing on adaptation, you will not also be able to keep the net zero course, so both are very intricately related to each other. And that is at the core. Then outside circle tells you that becomes the basis of your climate related planning. And this is a subset of an overall business strategy and growth strategy. So the strategy is not only about risk management, strategy is also about growth. And I think that makes this whole thing also very important for us to look at it from both perspectives. So challenges and considerations, of course, when there are so many frameworks, each one of them covers slightly different aspects from the other, and there is no guidance from the regulator as such on how to bring it all together. What does it mean? Where can we begin? I think these are some very valid questions that we will have to answer as we move forward. But we can also at the same time not really wait for the regulator to give very detailed guidance. How, I think what RBI has done right now has also kept it very open for the financial institutions. That does not make the job easy, of course. But what we are seeing in other jurisdictions was that initially the central bank began with an open-ended but sort of a format in terms of different kinds of things that you have to look at. But there is a movement towards templatization. So we hope, and I think, as we move forward, there would be more standardization and more templatization, which will be, I think, necessary for comparability and consistency also. But how can banks then put transition plans into action, including the credibility of their own transition plans will be an important thing, because we will be watched for that. We'll be watched for that by investors. We will be watched for that by the regulators. So how does this really become a tool? So is it something that you will do 3 years hence, or is it something that you can start doing today? So I think the proposition that we are trying to put on the table is that you're already doing other things. The idea really is to put it together in a systematic plan, and so it should be begun today. And RBI Disclosure Framework also has a question that if the regulated entities have a transition plan, what are the key factors and key assumptions driving the transition plan? You have been asked to also disclose. Moving to the next slide, please. I will quickly move into certain aspects which, again, will form part of the transition planning exercise and as well as transition plan, but a little bit just, some part of it has already been covered by Saurajit. But just to sort of reiterate, reframe some of these things, what it means when it comes to when it is a climate metric, when it is a climate target. So a climate related metric will have to go beyond historical and current aspects. It is a forward-looking climate-related metric. Saurajit has wonderfully explained, even has covered the canvas on the forward-looking nature of the climate risk itself. So the metric itself will also have to take into account how the bank will transition from a baseline to a certain target year and to a certain target threshold. And it, of course, it helps you track the climate related risks and opportunity, and also measure the progress against those targets. So that's about the metric. So if you look at, I do not know if you're able to see these diagrams. I have pulled them out from TPT basically, and this is a very handy tool that they are looking at and they're giving to they've put forth. So there is a historical aspect, then there is current, and it is informed by climate ambition. Ambition, please mark that word because it's an important one. That is what will help you set your metrics and targets in the first place. It will be determined by your overall ambition and strategy, and then those will be informed by the scenarios that you will have to take into account and certain forecasts, and all of this will come together in a transition plan. So metrics and targets will also form a part of the transition plan. The credibility of the transition and plan will be assessed if your metrics and targets are credible. So it is not something which is only a compliance measure, or it is only a disclosure aspect, but the entirety of the credibility and entirety of your journey will depend upon how robust your metrics and targets are. The other interesting part is that some kind of numbers will have to be given to these targets. And if you look at, say, in different scenarios, so if you're looking at opportunities, how much of your lending or investment in terms of numbers. So that is the calculation that you will have to bring about when you undertake this exercise. Moving on to the next slide, please. So Saurajit has already said that metrics and targets, they relate to both climate related risks and opportunities in line with the strategy and risk management process. This is the first requirement. The second one is that all the scopes are included. This is the second requirement. And the third is that there are explicit targets which financial institution will have to put to manage climate related opportunities and risk, and they will be, you will have to assess your performance against those targets. So what will it encompass for banks? I think I'm only paraphrasing what Saurajit has elaborated, but let us just reiterate. So it will be the amount and the percentage of carbon related assets relative to total assets. That will become important for you to calculate. Financed emissions, Sarojit has already taken up in detail. Now, where will they come from? What do we, so it's not only corporate lending and project finance, this could also be to other intermediaries, to NBFCs in the case of India, where, NBFCs usually financed emissions or facilitated emissions are thought of only as the ones that are going to the corporate entities. But in many cases, and by the way, this is also something that there is a lot of, eye on this aspect, that banking sector, because it is regulated and because there is disclosure norms coming into force, it is cleaning up its balance sheet, it is cleaning up its portfolio, and it will have to do so. But in doing so, is it shifting those emissions to the NBFCs, and they are lending to high emitting corporate entities? That is also an important aspect, and there is a term called for it, which is called emissions laundering, and the interconnected. So that's one aspect of it, that there is increasingly more and more scrutiny on this aspect, but also the fact that there is interconnectedness within the financial system, which means that the risk may actually move from more regulated entities to slightly lesser regulated entities. So that is something that needs to be kept in mind. Then we were talking about, of course, the amount of lending and investment decisions that you're making towards climate-oriented opportunities and activities. Of course, as I mentioned earlier, I was giving an idea of the credit exposure that will become very important. And the fifth point I've already covered. What we are seeing is that the current emphasis is really primarily and more emphatically on the credit aspect of it, rather than a whole lot of other, functions that a bank can undertake. It can underwrite, deals. It can also, there also investment banking, part of the banking functions. So all of those things also become important, that what are you facilitating? But primarily, as we are seeing, that it is the credit aspect which is taking a lot of attention and primacy. Very quickly, any metric and target needs to be verifiable, needs to be objective, and needs to be trackable. And it also needs to then align with the different pillars of risk management, of governance, and of strategy. Moving on to the next slide, please. I think we have mentioned this, but this was only to, say that you will have to have your metrics to assess the impact of both physical and transition risks, and in your lending and investment portfolios across time horizons. Now, this short, medium, and long term is quite a task, I know, for a bank. And right now, what RBI suggests, it leaves it to the bank, to decide what is the time horizon which it will find most applicable. But it may be a huge undertaking for banks themselves because different scenarios unfold differently in different time horizons and across different sectors. So whether the banks have that kind of wherewithal to do all of that on their own, and whether that will lead to any comparability, is also, I think, a very clear and present challenge. The other thing that, like I was saying, that it's not only lending, but your debt holdings and trading positions, etc. But right now, the focus is primarily on credit risk and the lending portfolio. But the things that one has to look at is, what is your sectoral exposure, in which geography, you have your assets, then your credit quality, and also the tenor of the loans. Then, of course, the banks will be required to provide the amount and percentage of climate-related assets relative to the total assets. So that will also help you assess and help the regulator assess what is the kind of. So there is one thing that you can go on lending to renewable energy, but the other side may also keep on either being static or may even in certain cases increase, which is the exposure to the high carbon sectors. The idea of all of this is that how the two things actually, so it's not that just ramp up in your lending and investment towards renewable energy will help you reduce the portfolio risk that you may be sitting on. So there has to be a very methodical and proactive action taken by the banking sector. Can we move quickly over to the next? Just wanted to tell you that in terms of quantification of metrics and targets, you can, of course, divide them into financial metrics and carbon-related metrics. And Saurajit has explained to you how these are calculated. But globally, I don't think Indian banks are alone in this challenge. There are some universal challenges on metrics. This slide is from Financial Stability Board. And what they found out was that financial risk exposures are, whether in terms of, probability of default, LGD, ECL, etc. Whenever there is quantification, that data or that, disclosure is very, very thin. Whether the regulators have done a bottom-up exercise with banks or whether they are asking for them to publicly disclose this, quantified metrics and targets are really not coming in either in the quality that is required or in the consistency or comparability that is required. Similar is the case on geographical location of assets at a granular level, forward-looking metrics, which is about portfolio alignment, decarbonization pathways. Again, wherever there is quantification required, I think we are at a very nascent stage in most jurisdictions, and one could even say universally. Then in carbon-related metrics, again, the scope 3 emissions are not reported, and they are much more difficult to get the data on anyway. And then there is comparable, transparent or ESG metrics and scores and ratings. The comparability isn't right now existing in substantial measure that is required for people to at least know that the same language, same variables, same metrics and targets, or similar way we are understanding both risks and opportunities. Moving on to the next slide, please. This we have already talked about, so I will not dwell on this slide at all. Saurajit has really talked to you about the GHG protocol and scope 1, 2, 3 and the PCAF, the tools. So you are already deploying some of these tools, but the requirement really is of quality, consistency, comparability and availability of data. We can move on to the next slide, please. In terms of targets, again, I think these are some basic things that need to be kept in mind. The credibility or robustness is almost always going to be checked against quantifiability of those targets and how granular those targets are. However, most of the times, regulators also encourage to substantiate with qualitative information. That is also important, and that's also important for a bank itself, because the explanation of some of those targets or the targets you plan to set needs to be explained in a narrative, in a qualitative measure, in a qualitative way. Then they have to be designed in consideration of bank's overall strategy and forecasting, and have to be defined by or informed by climate scenario analysis. Then they have to be specified over time, and they should be a progress that you should be able to measure against baseline and your final time horizon that you are measuring your progress against. Again, targets can't only be long-term, they have to be interim targets. There has to be, which can also be revised. It is not that, once you put something in place that they're written stone, but in fact, you're encouraged to actually periodically review those targets. And generally the timeline that we are seeing in different frameworks is that nearly a 5-year period can be taken as the base period within which the revision should happen, or by the end of which the revision should happen. Now we can move on to the next slide, please. This is what I was talking about. So there is not only a net zero target, which of course the emphasis here is on the word net. It means that the residual emissions from hard to abate sectors, and hard to abate sectors, industries is in focus, but transition does not only mean that it is hard to abate industries. Besides what is solar and wind, which is more pure play, the rest of the economy is transitioning from high carbon to low carbon. So even buildings, even agriculture, that can also be framed within this. Hard to abate sectors are getting the focus because they are much more difficult to, where the emissions can be abated. So that is currently the focus, but that framework with, or that it is a whole of economy that we are looking at. The second interesting target is carbon neutral target, which means that the emissions which are being generated by the organizations, they are being offset somewhere. In the overall, in order to make the overall net emissions zero. So that's called carbon neutrality. There is a zero carbon, which means that now every activity that you basically do or a service that you provide does not, it's near zero. So that is this, it's like a renewable energy company, or, if all your financing is towards renewable energy, that sort of a scenario. And then there is a Paris aligned target, which basically means keeping it well below 2 degrees and not exceeding 1.5. Maybe move on to the next one, please. This is something that I really wanted to share with you. And when we were talking about transition plans, bank borrower engagement becomes extremely crucial and critical part. And so how does one really make that engagement both fruitful as well as more accountable on both sides? And I think it is mutually productive. So what Climate Bonds has done is that it came up with a very fairly detailed transition plan framework for companies. Now, in this year, we are coming up with a transition plan framework for financial institutions. But in the interim, what we have found was that we have brought out this tool that if you are able to look at and look at the transition plans of the corporate entities who are your borrowers and measure them against certain very key parameters, which would include their maturity, which will include how aligned they are, what they, and then the transition plans, that can become very effective tool for FIs on 3 aspects. One, they can actually aggregate and disaggregate and differentiate between their corporate borrowers, their business borrowers, who are either aligned or who are aligning, so where they are in the journey. I think this helps disaggregating and looking at your portfolio in a disaggregated way. And once you have done this, it also actually empowers the financial institutions to develop that effective engagement strategy and roadmaps across their portfolios, because you know which portfolio or which sector and which corporate entity sits and what part of you'll be able to aggregate those risks and will be able to have the effective engagement around that. Then the other part is that credible corporate transition plans are actually a means to also enhance the credibility of financial institutions' transition plans. So they become a source of data, they become a source of very relevant information, without which you will probably be falling short on risk management, on metrics and targets, and bringing it all together in the form of a transition plan. Can we just quickly move to the next one? Because I wanted to touch upon a very quickly on transition finance. So I just wanted to say that transition finance is a subset of an overall green finance universe. It is that, here you are really looking at kind of processes, kind of technologies which may not be currently green. And they are hence called transition technologies. Such sectors are hence called transition sectors. So that is is a next basket of opportunity, so to speak, for financial institutions. Now, if you look at this data, financial institutions in India have been tapping this thematic universe, thematic finance universe, or thematic bond universe, to be more precise, to be able to on-lend to green activities till now. They have also ventured into sustainability linked sustainability and social bonds, and there is also quite a huge part which is on green loans. I think it is $14.3 billion worth of green loans have been made by Indian banks. But if you move to the next slide, till about 2 years ago, financial institutions were tapping this market, and there were about 41% of them doing so. In the last 2 years, we haven't really found, besides a couple of NBFCs and large, public sector banks, to be really making use of this opportunity. I say this with a great amount of, what should I say, emphasis over here, that when we are looking at transition risks and opportunities, the entire toolkit is what actually is important for the banks to look at, because for their own resource mobilization, for having the kind of investor diversification of investors. And we heard, I think, in the recent conference that IBA held, there were banks over there, and this was Axis Bank, which was saying that even though there isn't great amount of pricing advantage that one would find in multiple basis points, but the investor diversification is huge, and banks are able to tap a very different and a very targeted pool of investors, which also helps them look at the opportunities in terms of the innovation, in terms of the products, in terms of loans, in terms of the investments they are making. And I think this is where I would like to just stop, that the disclosure, and the final point over here being, is there a next slide? I don't think so. There is a next slide. Yeah, I think we're coming to the end of it. We'd definitely like more questions and interaction, but the final point that we wanted to make was that the disclosure norms that have been put out by RBI, they are a starting point, and they should not only be looked by regulated entities only as compliance to be done, because the nature of climate risk is such that if you do not prepare for the future, no amount of compliance or no compliance will actually help the case. So one has to really look at disclosure as a tool, as a strategic tool internally and with the stakeholders. Plus, I think the RBI is also going to come up with scenario guidance shortly. So together, it will give us more to grasp, definitely. And I think with some time, with some socialization, and with some expected actions on part of the banks and financial institutions, I think more standardization is desirable, and I hope that journey RBI will also take. But for now, there is, in front of us, I think, quite a lot of things to grasp, digest, and to create the systems within the organization to be able to not only respond to the requirements that are coming from the regulators, but to actually make each one of the financial entity climate proof and a future fit. So I will just end it over here.
Yeah, Neha, actually, there is a query raised in the chat box. I just read it for your benefit. While climate risk assessment, while onboarding a client is possible, but how to assess a climate risk of an existing standard asset portfolio, more so for a term loan which is already fully disbursed.
Do you want me to take that, Neha?
Saurajit, please do.
Yeah, thanks for that question. So yeah, so naturally, the extent to which you can do this in the existing loan book and exposure, where, irrespective of whether the entire deployment disbursement is done or any tranches are left, would be limited naturally. But that said, a lot of facilities that are up for, the facilities are up for renewal. And when in that situation where credit assessment, would be done afresh, that is really where you can technically look at it as equivalent to a new loan proposal and do that. But that being said, the entire topic of climate risk management, I mean, these are not to be seen only in purview of the new loan proposals. Even in existing loan in the existing loan book, it is useful to know what the baseline is. You really need to know where it stands. The assessment approaches, by the way, are not established sacrosanct right at the very beginning. In most banks, 99% of the banks, it's an iterative process, it's an evolutionary process, and that process gets strengthened over time. So most banks would typically start somewhere. So let's say you start with the new origination and then subsequently move to a larger footprint. So that's really, and especially where obviously in existing loans where there is, I mean, you cannot include new conditions, you cannot include new covenants, but there is still some merit in doing that same, the assessment process is the same. I mean, you're still evaluating the forward-looking cash flows to some extent. So even if you do that process, there are certain qualitative inputs you can give to the company, because see, a large part, a gap exists at the level of the bank vis-a-vis the borrowers. There's only that much the banking regulator, what they're saying, can do for the bank. Ultimately, it's also the end borrowers and whoever are the respective supervisors for those companies' affairs. That is also to align in terms of all these new things. So obviously, there is a gap as far as the banks vis-a-vis the borrower corporates are concerned, especially the corporates that are outside the large listed corporate universe, who are outside the BRSR and all that. So it's all about also giving them the qualitative inputs time and again, that this is where you are. Many companies themselves are really at a very nascent stage, including some of the larger companies. It's also another myth I want to debunk, that the larger companies are necessarily the ones who are most proficient in these topics. It actually depends on the company's agility. Some of the companies, mid-sized companies, are also pretty agile. So it really depends on the situation, it depends on the context, and it makes sense to have some qualitative discussions, even if the terms of the loan, terms of the credit facility are not getting, changed or amended. Even then, some qualitative inputs is still useful to set off the process. It's useful to set up the conversation. It's useful to sort of create that awareness. So that's really the point I want to emphasize in this. Neha, if you want to add anything.
Yeah, just one more thing to add to the point, what are large companies doing? I think some of them have started putting or analyzing the risks they face, both on physical and transition aspects. But what we have found when we were talking to them, we continue to engage with them, is that they are learning, but something that they, at least 3 or 4 companies that we have been engaging in the hard-to-abate sectors, these are steel and cement companies, very large ones. They say that actually that engagement piece with the borrower, while it is important for the borrower to engage with the companies themselves find it a very important aspect if transition has to be more aligned and probably faster. Because right now what is happening is that when they want to raise capital for their transition, they say that they don't have any kind of structured offer by their lending partners. And I think it is part of it is is because of understanding and assessment by the financial sector entities themselves on how they are confronting and managing these risks, as Saurajit just elaborated.
Thanks, Neha. Actually, there is the next question. How to assess the financial emission for retail and consumer loan?
Where is it?
Mr. N. Ravikumar, Tamil Nadu Mercantile Bank. How to assess the financed emission for retail and consumer loans?
That
In the retail consumer loan section, generally the retail mortgage and the auto loan sector is something that most banks have started to look at. Most of these have a high transition risk exposure, and generally that is the first port of call that they're starting to look at, aside from agri and those sort of things. But yes, in a sense, the value of financed emission calculation lies more on the wholesale book than the retail book, generally speaking.
and in other countries, I think the on the housing loans, mortgage, etc., is now, because properties are at risk of both physical as well as transition risks. You know, those energy efficient buildings, if they are not really energy efficient, then the rental values are collapsing in many economies. So that's how they are basically assessing. So they look at their portfolio in terms of the mortgages and the risk that emanates from that. But in India, I think it is more in the sectors, more agri perhaps, Saurajit, and automobile. Are there more questions?
Is there a place we can open the chat box for the questions? I'm not able to figure out.
I'm also trying to
Can
find the
we-
questions.
Sir, I think you will be able to see the chat box actually. Yes. Presenters, all the presenters will be able to see, sir.
Yeah, I think I'm seeing this now. Let me just read this slightly congested space over here in terms of the NGF
I can read it
scenarios.
for you, Neha. Actually, the next question is,
Okay.
can you share some sources of data for physical and transition risk that can be used for a portfolio level analysis?
So one, definitely, I was trying to put a reading list also together in this PowerPoint. We will give that to you, but bear in mind that a lot of these reference frameworks, etc., are international, NGFS, IEA, and now Niti Aayog is undertaking this exercise to look at a national trajectory and looking at those scenarios as well. But we may not get very granular data here. In fact, that is one of the challenges that exists, that even in terms of physical risk data, hazard data, even that is lying in different entities, whether that is IMG, and then there are also private entities. So there is a need to put together some kind of a common data repository where some data can be accessible to the financial institutions, which has not happened yet. And I think that is a very valid demand as well. But definitely we'll put the resources that can at least be started with for everyone to look at.
Share further information on this. In our feedback to RBI, we have suggested a collegium of the regulators, RBI, SEBI, and then PFRDA, IRDA coming together.
Yes.
And each one is a repository of a set of data actually to pull it together actually, and bring it granular data with the geospatial indexing actually. So that could be the best possible solution in the Indian situation, is what we have suggested to the regulators.
That's an excellent suggestion. So, I mean, I also have a question to you, Mr. Chandrasekhar. So, where will that data be housed? Will that be a body like IBA or MOF or Niti Aayog, or what's the current thinking?
We may have to think in terms of an technology provider actually. It will be technology intensive. You need too much of data crunching and indexing. So that could be housed in a technology provider with the ownership being resting with the respective regulators.
Sure.
Okay. For the next question, scenario analysis seems to be dependent on the respective bank's entities' assumptions. Is there a possibility to have some common scenarios, factors which can be adopted? The basis of this question is non-availability of data.
Yes. Scenario analysis seems to be dependent on the respective banks. And yes, so thank you for that question. Right now, I think the approach that we are seeing is that the regulator has left it to the banks, but RBI itself is a member of the NGFS. And those are the scenarios which it takes as its guideposts. And I think we should see some more guidance coming in terms of the scenario guidance from RBI. But what we are hearing from RBI is that that will be the main reference scenarios that they will use and they will like entities to use. But also to just mention over here that NGFS may not be the most, what should I say? There are many variables in NGFS scenarios which probably do not count for emerging economy, situation. So there has to be some kind of adaptation of NGFS scenarios to the Indian reality as well. And in fact, in the work of the India Initiative on Climate Risk and Sustainable Finance, we are trying to do that for power sector. We are looking at what are those models that NGFS looks at and what are those kind of adaptations that will be required in the Indian scenario, given its, energy demand mix and an energy projection and, the pathway forward in the power sector. So there is some work which is happening. So that will also be out in the public domain. But we should expect some more guidance on it from RBI. So Rajit?
Just to thanks, Neha. So just to add on that question, see, a lot of banks, in different emerging markets that we have been working on as part of our advisory and projects with clients on ESG and climate risk and sustainable finance. What we have understood is that a lot of banks, they're using their own decisions as far as which reference scenario is concerned. That's point number one. So if you look at NGFS, if you look at any of the generally accepted reference scenario authorities or bodies, whatever I call it, so there are typically 4 or 5 different scenario levels that they look at: base, worst case scenario, base case, best case, etc. What we've understood from a lot of banks is that they don't really want to look at the two extreme side of the scenario. So let's say the initial analysis must start with 2 scenarios, not really 4. 2 is more than sufficient. A good case and a worst case. But those good case and worst case reference scenario that you select should not ideally be the 2 extremes of the NGFS, if I put it that way. This is not to be taken as a universal rule or truth. This is what I'm just saying from general observation of what most banks in the market are generally doing. Okay, the reason why we may want to avoid the two extreme scenarios of a reference scenario body is because the reality may lie somewhere in between. The world may eventually move somewhere in between. So whatever are the 2 nearest scenarios, so let's say the worst case or extreme best case, if you remove that, whatever are the 2 scenarios in the middle, that is what they take as reference scenarios, assuming that in reality things will move somewhere in between. And then once you take those 2 reference scenarios as the base, as the reference, you may want to adjust the assumption a bit, just like Neha said, that it has to be contextual to the geography. What is happening in the Western market is not necessarily true for a tropical region country like India, right? So you may have to sort of make certain assumptions, and that's where the internal stakeholder analysis comes very important, because you need to reach a consensus within your bank. Now, unless, of course, there is some guideline, a firm, uniform, definition-based guideline that is coming that this is exactly what is to be assumed, as long as it is discretion based on the banks, obviously the assumptions between the banks will vary a bit. But generally, what I'm trying to indicate is this is the sort of focus approach that most banks in the market are taking. on scenario assumptions.
Yeah, taking a little bit more time on this. In some of the conversations that we've been having with experts in the energy sector, in the power sector, with Niti Aayog, and if you look at the NGFS scenarios, they think that the NDC scenario, a delayed transition scenario, and I forget the third scenario, which basically means advanced or a more progressive scenario. Those are the three scenarios that they said that we should be basing our research on. So this is just some tidbit that I'm sharing with you, that this is what is, what the experts in the sector, they are basically saying that this is where India will be headed, at least in the power sector.
I saw a question from Dr. Bhaskar. Is there any consultant? So that's what we're here for, sir. So on a lighter note, that's exactly what we do. That's what we're here to. But one thing I want to also emphasize is, in this context, for the benefit of a lot of banks who may be looking at external support, do keep in mind the scale of engagement that you may be looking out for. And why I say this is because as part of our work, we have been going out into a lot of Asian markets, talking to people there, especially including not just the financial institutions, but also the consulting community. And the way we've seen it work with a lot of because there is a sort of a feeling that, the international consultancies may bring more value but the way the business model works there is the climate specialist is essentially based in one or two of the financial hub locations, international locations, and that particular person is mapped to a number of projects, the local level engagement teams of those consulting firms in India, in Bangladesh, in Thailand, Malaysia, whatever XYZ is doing. So there's only that limited time of engagement that you may get where we are based in this country, both Octus, CBI, we are based in India. In that sense, when we are engaging with our clients, we are able to give a much more dedicated time to sort of help them navigate the issues, help them understand, because obviously these are nascent topics. There's a lot of handholding, a lot of understanding that is required. So I would urge you to keep that point in mind, because that often does not get covered in a lot of RFP documents that we have seen. And I think that this human aspect of it, the human aspect of the amount of engagement, the scale of engagement, is an important consideration that should be kept in mind as far as decisions to engage an external consultant is concerned. Knowledge is the same, let me assure you. The knowledge is the same. We've interacted with people from all across. We engage people with all across. There's a recent climate transition roadmap report for banks that I have brought out. And, I've spoken to a lot of bankers across almost 15, 16 markets for it. And just to take a very recent example. And even then, as recent as 2 months back, what I've again seen is that, the knowledge is largely same. The knowledge is same across all the markets. It's the engagement, it's the degree of engagement that really makes a difference. And that engagement factor is something I want to sort of, I urge all of you to keep in mind. Dr. Bhaskar and even others, thank you.
And what we do intend to do, and we have been talking to Mr. Chandrasekhar and Mr. Mehta on this, is that we will go forward and, we will engage also individually with some of you who of course would like to, and we have worked already and with and to see and to really understand and be able to support you on your key demands, so to speak. Where is that support required? The other thing, while climate bonds experts and Octus ESG are here, our other partner, ODI, and as well as our network of experts is something that we would like to bring to the table when we are engaged in these conversations, to get the advice, not only which is contextualized, but which also gives you good practices, which also looks at how some other banks in certain other jurisdictions are looking at this and managing these challenges. So we would like to bring that to the table as well. I think there are more questions, right? Am I missing
Another 2,
something?
3.
So can you suggest any material which we can refer to find out guidance for climate risk management and emission estimation in agriculture sector? So on climate risk management, which is there is some work that we have done, which we can share with you. But on estimation of emissions, I think there is not a very comprehensive work which has happened. However, there are a couple of papers that have come out, and it is more so coming from the fact that agriculture sector is looked at more from the resilience point of view, climate resilience point of view. So emissions reduction, detailed analysis, I'm not very aware of, but I think RBI itself has looked at emissions coming up from agriculture sector, but we'll have to check, and we will get back to you on any good material on estimation of emissions in the agriculture sector.
But on that agriculture emission question, a lot of, there have been cases of banks in other markets where they are essentially looking to create incentive structures. So you give a bit of an interest rate discount for a lot of the larger agribusiness clientele, for instance, to sort of engage in their own emissions estimation using whatever internal or external support, whatever they want to. But at least to fast track the process a bit through incentivization, because technically agriculture works a bit differently than other most real economy sectors. So just wanted to add that point.
We do have some broad sort of hallmarks or criteria when you look at agricultural transition, but that's the work which we are doing in other emerging economies like Brazil. And so there is definitely some knowledge that we can share, but estimation of risks on emission risks is very difficult for India. I think I haven't come across a comprehensive study on that yet. There is a question.
Just to subscribe to your son, whatever little we have come across in agriculture, it mostly relates to biodiversity and then actually water conservation and other issues rather than on the emission part of it. Actually, whatever we have come across.
Yeah, and so agriculture value chain, I think all of this becomes very important. So it is not only on farm, it is also off farm emissions that are related to the activity in the value chain that also then count. So there is all of that definitely. But yeah, as I said, but whatever we have, we will share that. There is another question which I'm reading over here. It is, in view of the fact that taxonomy is yet to be adopted by India, how should we practically approach transition finance? Okay, should we base our classification on some other taxonomy or classify our portfolio retrospectively once taxonomy is adopted? That's a very good question, and I can at least answer that from as a person who was on the taxonomy development working group of the Ministry of Finance and is still waiting like everybody else. So IFSCA has just done, I was part of the committee of IFSCA on transition finance. And the approach that it has taken is that, again, because we don't have our own taxonomy, and by the way, the taxonomy that was being developed by the Ministry of Finance was more for the green sectors, if you could put it like that, and transition activities were to be taken up in the subsequent course. But that paper should be out. What it does very conveniently, which makes things convenient for everyone, is that it recognizes certain taxonomies that can be used, which are either, international jurisdiction, because IFSC is trying to get international capital into India. So it recognizes jurisdictional taxonomies like Singapore, like ASEAN, like Japan, and also recognizes taxonomies which have been brought out by standard setting bodies like Climate Bonds Initiative, ICMA, and others. So it gives you a whole bouquet, and it gives you a paper which is actually which tells you how to look at transition finance when you are going either for lending or for bond issuance. So let's wait for that. But what I'll just like to say is that some of these market-based voluntary instruments are already at play. So please do look at the standards which are there. Because they are geographically agnostic, you might find some part of it slightly more difficult, but all of us are really beginning in this space. So things will improve and will evolve. And in fact, climate bonds itself is looking at trying to address some of these regional variation when it comes to transition sectors.
Just to add, I would urge, a lot of participants who are interested to sort of read the Singapore transition taxonomy that's come. I think that is a very relevant document from an Asian perspective, and it gives a very interesting, very simple to understand traffic light system sort of a coding of a lot of activities that are economic activities that are actually described in detail in terms of sub activities and etc. While Singapore as an economy is obviously not comparable to most of the Asian emerging markets, but nevertheless, as a document is concerned, I think that's quite a interesting document. In case any one of you requires it, do let us know. We'll be happy to share it.
Yeah, all of that is also contained in this IFSC paper, but please just go have a look at the Singapore taxonomy. It in fact builds upon the framework that Climate Bonds Initiative put out in 2019 on transition finance. It divides the activities into 4 types. One which are near zero, which could loosely be called green activities like solar, wind, etc. Then there are on the pathway to zero. And then there are certain interim activities, and there are certain activities which we should be transitioning out, like solid fuel, coal-based activities. So there are activities which we are transitioning in, and there are some certain activities which you're transitioning out of. And it's a very simple sort of it can be converted, or it is very amenable to a traffic light system, which is what Singapore taxonomy has done. But we can also share both the Singapore taxonomy as well as the climate bonds conceptual framework, I think, which will be helpful.
Just continuing on, not continuing, but something related to this topic that reminds me, and I think that's also worth mentioning, is because a lot of bankers, I think there was a couple of questions previously also that talking about the data barrier, so the data aspect of it, what are the data sets, what are the data, etc. So what we have also seen, and again, I'm using an example of an Asian developing country, without naming it in this case, is that and this is really where the advocacy role that the banking association and the front-running banks in a particular market can really play with the regulator. What they have come together, all the related stakeholders in that market, and they are working towards a web-based data utility tool. So essentially like an in-house free-to-access database of various contextualized data points. So not just corporate data, like one-stop shop for all the corporate disclosure data, but also for a lot of the data that you may want to import, emissions factor, etc. And then they are trying to put together contextual assumptions to it. And then the banks can sort of refer to that one-stop sort of a database or data utility, whatever you call it, open access, free to use, in order to do their own, respective calculations, estimation. So what this is really trying to do is it's trying to navigate the data challenge that right now each individual bank is facing and they're grappling with. And to be very fair to the banks, at the end of the day, the idea is to sort of streamline the process as much as possible. And I found this example very interesting, where obviously every stakeholder has something to contribute, and they're coming together and creating a web-based data platform that can be used. I'm not naming the country because they said that since it's a WIP, it's something that they would be releasing out in press release after it gets released. But the basic idea is very interesting. And I think since we are all here at this forum, IBA has kindly convened, I think it's worth mentioning that this is also something that is happening in the world. And by the way, very close to our country. It's an Asian developing country that I'm talking about. And something that should be explored. It really will resolve the data challenge that is probably one of the primary challenges that most banks are grappling with to a large extent. May not solve it completely, but definitely to a large extent. So just want to add that. So one side is the definitions part of it, unified definitions with the taxonomy, but then to apply it, you need the data. So that's why I thought that I should mention this particular example. Thank you.
There's also another question, Saurajit, I'll just read that out. Any idea by when is RBI expected to come up with a standardized framework on climate risk stress testing of bank portfolio, where common assumptions in green, non-green sectors would be prescribed, which scenarios to be adopted for climate risk evaluation, and what would be the common time horizon to be adopted by all banks to avoid arbitrage across bank reporting? All very critical questions and expectations from the regulator. Now, what we do know is that the scenario guidance is up to come out shortly. That shortly could be very soon to a couple of months. That's what we know. But, and what will that contain? Now, will that only be pure scenario guidance, or would also have features for or some kind of standardization of climate stress testing? Well, we cannot say anything about that. But since it is a guidance, there should be some kind of comparability and consistency that we should see coming out from RBI in terms of guidance. The other thing what RBI has done is that in lieu, when you say green and non-green sectors, what it did was that because it's also been demanding a taxonomy, and that taxonomy development work has been in the purview of the Ministry of Finance. That in lieu of that, till the time it comes, it has taken the lists that were contained in the green bond framework that the sovereign green issuance followed, which has 9 categories that it includes and certain activities. It is not a taxonomy, but at least it gives you an indication of activities that RBI, until the taxonomy comes, is encouraging financial entities to follow.
Just like the expectation of the banks from the supervisor, we've also had instances, just adding here, sorry, we've also had instances where we've had the supervisor asking us that what are the banks, where are the banks in terms of preparedness, what are the issues they are facing, what are the challenges they are facing, because obviously they also want to take those things into account when devising the guidelines and their processes, etc. And one of the interesting questions that came recently that actually, I mean, most of our audience who are from the banks, they are the best to answer it, is that how has the reaction or the uptake to the green deposit guideline that came out a few months ago has been. So RBI, I'm not sure. I mean, I'm sure there have been internal communication between the banks and the IB and the RBI on this. I'm not aware of that, but generally I'm saying that RBI is very how do I put it, very receptive in the sense that wanting to understand the feedback of the market as far as existing guidelines, and probably these are the excellent advocacy opportunities that banks have to sort of put forward their points of view. I'm sure they do, but I'm just sort of sharing what we have also come to know. So in the same way, because that also sort of determines the pace at which the work, in the sense that if you get more inputs, like I understand a lot of inputs have already been given. So depending on the inputs, the sort of future guidelines become more strengthened, they become more relevant, they become more contextual, and that would really create a sort of a very well climate action-oriented ecosystem, while not foregoing the basic commercial motivations of the banking business at the end of the day. And I think one really needs to commend the IBA and RBI's, sort of proactive role in sort of receiving or being receptive to the market inputs as well on this. Just wanted to add that. Thank you.
And what we also try to do, as India Initiative, to connect both the research at the macro level that we are doing with a lot of feedback on the ground from the bank. So that is the top-down, bottom-up approach and the feedback loop that we keep on, we actually make it a point that we follow that. And RBI has found that to be very useful. Of course, it reaches out to you separately as well for feedback, but it is also very receptive to the work, which brings all of these perspectives together. So it is trying to inform itself the very best way that it can, no doubt about it. There's a question by Shweta Rai, I think, which is, are there universally accepted standard benchmarks for different industries being used in India in reference to their emissions, which can be used while analyzing a company? I can go on a little bit on this, but I will not take too much of your time. There are international standards and benchmarks which are being recognized and adopted by certain companies in hard to abate sectors as well as in other sectors. One of them, as I mentioned, is ICMA. They are not very specific in terms of criteria. That kind of work is done by the Climate Bonds Initiative. So there are certain criteria that if you are looking at, okay, how do I assess, is it really green or not, or is it adhering to certain thresholds when it comes to emissions reduction? We will share those documents with you. In fact, the IFSCA report, it should be out soon also. That what we did was, in that committee, we actually really put together a whole lot of these kind of links and reading and resources together in one place, and also mapped out the entire canvas, both of mainly with the focus on transition sector. So there is a lot out there, but I will definitely in the meanwhile send some information which will be helpful.
You could also look at the IEA scenarios that have a lot of sector specifications.
Yeah.
And we find a lot of banks are actually adhering to that for sector specific portfolio target setting and sort of decision making in this front.
Yeah, I think Neha, I think we'll have to close down this discussion. To the members, actually, if you have any further questions, please do write to us. Actually, we will take it up separately with Neha and Surajit. Actually, and we'll come back to you with their answers. As we are running out of time, actually, that we'll have to conclude the program today. Neha, if you would permit, actually, can we wind up?
Yep, absolutely. So I will just give the floor back to you, and thank you for this opportunity to have this session, which we thought was just an introductory session, but the engagement and the questions are very, very encouraging. And it also goes to show that I think you yourselves are traveling the distance pretty, progressively and steadfastly. And we will be in touch with many of you, and we will also organize some in-depth sessions on particular topics in consultation with IBA and yourselves. And I'll give it back to Mr. Chandrasekhar for his final remarks. And thank you, Sarojit.
Before Mr. Chandrasekhar, just maybe I'll just take 10 seconds.
Yes.
Sorry for extending the time, but thank you for all your attention and the questions, and thanks to IBA. I just saw a very interesting question suddenly pop up from Mr. Vaidyanathan on the hedging aspects of climate risk. That is, by the way, I would request Mr. Vaidyanathan if he could email that question and we'll get back, because there is a lot of discussion internally about the fact that certain hedges. So one is the frequency with which certain issues happen. So when you do insurance is generally for risk factors, risk issues that occur a lot frequently, but have limited impact. But climate is the opposite. It has larger impact, even if it may occur once in a while. And that is really where the dichotomy between using insurance as a hedging mechanism for climate risk is concerned. But there have been different product developments that have happened, and it's a very interesting topic to discuss. It's actually worth a full discussion in itself, that particular topic, because that is a topic we've been discussing a lot internally as well with a lot of people. So would be great if you could share across that question. Maybe we'll take it later. Mr. Chandrasekhar, over to you, sir. Thank you so much.
So, friends, thank you very much, Neha and Sarojit. It was a very informative session, and judging by the the nature of questions that I've emanated, actually, I think actually we have touched very important areas of this discussion, and that has brought forth a lot of questions from the members who have attended it. Actually, I think everybody would have benefited by the knowledge sharing that you have made today. We look forward to more such sessions actually going forward. And just for the information of the members who are attending right now, actually, see, we are going to Climate Bonds is going to get in touch with you, all of you, to look at what are the areas in which you would like to have intensive this one actually, and maybe actually as informed to you during the course of this session, that they are planning to assist some of the member banks actually in their endeavor in transit planning also, to the extent actually possible, and they'll be in touch with the member banks actually to find out what are the needs they have actually, so they can structure. So either way, we need input from you to structure the oncoming sessions, and also for Climate Bonds to assist you to know what are the areas in which you will be needing assistance. So there also they'll be needing input from you. So I request all of you to be in touch with them actually and give the necessary inputs, so that the next oncoming sessions could be equally interesting and equally profitable to everyone else. So thank you, Neha. Thank you, Subhajit. Actually, it has really been a fantastic session. We really enjoyed it as much as our members also enjoyed it actually. So we look forward to more such occasions actually. Thank you very much.
Thank you.
And
Thank
my
you
thanks
so
to my members actually who
Thank you.
have attended in numbers actually. So, and also to for raising so many relevant questions actually. So which means that actually everybody is interested in these sessions and in these topics actually. So we hope to carry forward our contribution by of arranging more such sessions in future. So please do on the lookout, be on the lookout actually for such invitations for the webinars actually going forward. Yeah, thank you very much for joining today, and we look forward to meeting you in the subsequent sessions. Thank you.
Thank you so much. Thank you, everybody. See you soon.
Yeah, see you. Thank you. Thank you, Mr. Selsi. Thank you.
Thank you. Bye-bye.
Bye.